Hello, everybody. This is Dr. Richard Smith with the Foundation for the Study of Cycles, and it is good to be back with everybody. Been a few weeks back from New York City. The conference was absolutely epic. I really think it was historic. A gathering like this in the cycles community has not happened for decades, and it was an amazing event. There's so much love for the Foundation for the Study of Cycles out there, pent up, that I was blown away. It was just incredible to be with 100 people in New York City for 3 days, talking cycles, hearing from legends in the business. Peter Eliades, Larry Williams, Sherman McClellan, Jake Bernstein, Elliot Prechter, son of Robert Prechter, of course, Lars von Tienen, myself, Andy Pancholi, Ron William, Bill Cerubi. And everybody had so much to say. Everybody seemed like they just hadn't been able to talk to anybody for decades. And so I wanted there to be more like exchange and dialogue, but every presenter just like had so much to say, and all the presentations were off the charts. The forum, the space was perfect at SUNY Manhattan, their global center. Wow, it just was incredible, so inspiring and encouraging and affirming for the work we've been doing here, and a bright light for the future of the Foundation for the Study of Cycles. So lots to come. Still unpacking and really recovering from putting on the conference, and just getting some rest, and consolidating the wins and planning for the next year ahead. Obviously, people want to get together in person again. But I think there's a lot we can do collaboratively, especially using some of these new technologies that allow us to kind of search our communications in a new way. And of course, our ever improving, incredible technology that Lars announced some major upgrades to the technology. He's sharing a little bit of that with you today. Lars shared some yesterday. We are fully integrating these new AI technologies and old AI technologies, and working with our collaboration partner, Tom Keller from CrowdSmart. Incredible resource, such a history that Tom has in the AI industry, also with a background in physics and magnetic resonance physics, which has to do with cycles and periodicities. So couldn't be more excited about what the future holds for the Foundation for the Study of Cycles. So today, gonna look at some cycles on fundamental data. Really was, Larry Williams gave a presentation. It was so good to have him there in person. What an honor. And really incredible presentation, and really challenged us as the Foundation to focus more on fundamentals. Larry's as big of a cycles guy as anyone, but he really understands that cycles are not necessarily driving the market. They're present in the market, but that there really are things going on in the economy, like inflation and unemployment, two of the big ones that have very cyclical patterns in them, and that represent real conditions in the economy. You know, Larry told a great story about being a mechanical trader versus being a discretionary trader. And Here at the Foundation for the Study of Cycles, certainly we engage in a lot of technical analysis, but we're also really trying to understand the big picture, right? And find out what these cycles are telling us about what's going on in the real world. And in that sense, understanding cycles to have some discretionary components to our decision making based on an understanding of what's really happening. So I think you'll find today's presentation interesting and educational from that regard, and helpful in terms of hopefully navigating what is ahead of us. So with that preamble, welcome back, everybody. Thanks again. Please bring friends and family to the Foundation for the Study of Cycles. Hit the subscribe button, help us grow, because we got a lot ahead. So, all right, let's take a look at some cycles. Let me get set up here. I haven't shared my screen yet. All right, so we're going to start back here, and of course, take a little peek back at where we were when we last got together. We were looking for some trades based on 2-hour data. And we went through a lot of different assets that I trade in the futures markets, and settled on two that seemed to have the biggest support from the daily data and the 2-hour data. And the two trades that we settled on were the NASDAQ. These were the daily cycles that we looked at back in May 26th, about 3 weeks ago. Lots happened since then, right? And the daily cycles were certainly supportive of the idea of an up move in the NASDAQ and the S&P, but the cycles were better, crisper, more well-defined in the NASDAQ, so we stuck with the NASDAQ. And indeed, the cycles have played out quite nicely in the NASDAQ since that time. We are, of course, approaching the cycle top right now from the daily data. And look at the momentum divergence here too, which negative momentum divergence in spite of new highs in the futures prices. So good forecast by the cycles on the daily data. And the 2-hour data that we were looking at back then, also we were about here on May the 26th. And did get a pretty decent move. Not a great move, but by the time the cycle peaked, we were at, what is that, 21,663 versus 21,183. So almost 500 points in the NASDAQ on the 2-hour data. We can see, though, even on the 2-hour data, I'm just seeing this momentum divergence everywhere right now. Big negative momentum divergence in equities and in crypto. The second trade we looked at was gold. Of course, we've known the gold cycles have been topping for a while, and gold hasn't really followed the cycles that well, but this was the setup back in May the 26th, kind of coming to a top in a couple of gold cycles. And we looked at the 2-hour data, also topping. Gold was at about 33.41, and by the time the bottom of the cycle hit, it was at 33.08. So, not a great trade. Had to go through some pain to the upside, but ultimately did get a little bit of profit there by the cycle bottom. So that is what we looked at last time. Always like to review and see if we can learn something, see how we did. And I'd say not bad. All right, moving on now. I want to talk about fundamental data, and in particular CPI and unemployment. And here we are at the Fred data site, Federal Reserve Bank of St. Louis, fred.stlouis.org. And I'm just going to show you how we do this. So CPI, consumer price index for all urban consumers here. And then edit graph and go to percent change from year ago. Okay. So this is data. It is monthly data. Okay. And that's why you can't pull it in directly from Fred. We do have a connection to the API for Fred data, but if it's not daily or weekly data, we're not able to process it automatically. So we have to download it and then upload it into the Cycles app. So I'm going to download the data here, the CSV, save it, open it. Going to change the columns to date and value. I know that's probably impossible to read for everybody, but it doesn't really matter. I'm just showing you putting the column headers in of date and value. I'm going to save this, exit, go back to now the Cycles app, open up a new window, go to data sets and upload new. Browse, pick the new data file. And again, this is just, this is monthly data, but we don't have an option for monthly data right now. So we're just going to set it to weekly and give it a name. And save and open data set in Scanner. All right, so here's the data that we just downloaded from the St. Louis Federal Reserve. Let's make sure we've got all of it. We do. And I'm going to even incorporate that last bit into our cycle analyzer here. And right away, we see a big spike in the spectrum, the biggest spike right here at 65 months. So this is a very prominent cycle in the inflation data. It's so obvious that I'm amazed that we're not talking about it in the media, that there's a 65-month cycle in the inflation data. I mean, if you got nothing else from the Foundation for the Study of Cycles besides the fact that there is a 65-month cycle in the CPI, that right there justifies our existence. Okay. So, I mean, just look at this: bottom, top, bottom, top, bottom, top. As Jake Bernstein said in his presentation at the conference, why does the Federal Reserve need thousands of economists when the cycle here is so conspicuous? So where are we today in this 65-month cycle here? Let me make this full screen. And we can see that we are right at the bottom of the cycle. Now, there has been right translation in these bottoms for the last few iterations of the cycle, right? Here in 09, we had right translation by about 6 months. Okay, here in 14, June of 14, bottom actually hit in January 15, so also about 6 months. Here in 20, January of 20, took about 5 months till we actually hit a bottom in CPI. So this could continue for 5 or 6 months, but we're clearly closer to a bottom in inflation than a top. And while we're here, just going to jump back here to the famous Volcker era, Burns-Volcker era of inflation in the Federal Reserve, right? So this was the peak in 1970 at 6.4%, came down to 2.8%. We're a little lower than that right now, but we were a little higher than this back then. And then we got these famous 3 peaks, right? 74 and again in 79, right? So let's say we're here. If we are, then 65 months gives us some, I think we're near the bottom already. There's a lot of right translation here. So just looking back at the 70s, because I do think it's something we should be paying attention to. So now if we go back here and remind ourselves of where we are in the current inflation cycle, we're at the bottom. Momentum in the cyclic RSI is not really turned up. So again, I think we could get lower inflation here and some right translation in the bottom. Might be especially, waiting for a significant turn up in the cyclic RSI, maybe by the end of the year. But like I said, closer to a bottom in inflation than a top. Oops. All right. So let's look just a little more closely too at the data, see if there's anything else we want to pull in. So by the way, I'm using the new stability score here. 67 is the stability score of this cycle. If I sort all the cycles by stability, Lars has talked extensively about the stability score. So let me just see here. I don't want to spend a ton of time on it, but the second biggest cycle here, 176, suggesting maybe another month or two before the combined cycles bottom. And I think that's those are the two strong, most stable cycles. Okay. Still though, I don't really need more than this 65-month cycle. The strength is off the charts. Maybe look at that 34 plus 65. Maybe that's where the right translation's coming from. Okay, you get the idea. CPI, closer to a bottom than a top. Let's move on. All right, here is the CPI less food and energy. All right, take the food and energy out because it's more volatile, and you don't get as much change, as much volatility, but you still absolutely see the 64-65 month cycle. This goes back to 1958. I think that might be as far back as it goes. So again, very clear cycle. You do see here momentum really has broken out of the bottom of the channel here when we take out the food and energy, and hasn't turned up yet, but again, very clear on the spectrum. And then this 128, 130 in here also is interesting because it's 2 times 64 and also has good stability at 54. Stability above 50 is good. Any way you look at it, we should be at least reaching a local bottom in inflation. And it's just fascinating that these cycles are so well defined and so obvious in the data. All right. Here is shelter inflation. CPI on shelter. Look at this 64-month cycle. It only goes back to 91, so it's not as far back, but that's plenty of iterations of the cycle. Stability of 74, very well defined on the spectrum. We see this 97 cycle also good definition, not as good as a 64, but still worth looking at. But either way, shelter inflation still has some room to come down. We looked at this back at the beginning of the year. We said, CPI, full CPI likely to bottom sooner than shelter. Shelter still has room to go down on the 64-month cycle. And when we combine it with the 97-month cycle, it's got even more room into mid-2026. And momentum is just straight down on shelter. So we should expect shelter housing to continue to not be as inflationary as it was a year ago. And then finally, PPI, also what we looked at earlier this year. I did a presentation on this. Solid 64-month cycle as well. Very well defined on the spectrum. #1 rank in terms of spectral analysis. We do have some other cycles in here too. The 190 has very good stability. It's 95. But anyway you look at it, producer price indexes are producer price inflation looks like it has bottomed and is heading up. So producers are going to be getting more costs as inputs, right? But it doesn't look like that's going to get passed on to the consumer right away. So that's interesting. We'll see what happens. But it's interesting that producers are seeing their inflation pressures up, but the consumer price inflation still looks like it's got a little bit of room to potentially go down a little more, even though producer prices are going up. That's what the cycles are showing. So that's a pretty clear picture on inflation. Fantastic picture. If you want to hire 1,000 economists and try to figure this out instead of letting the cycles tell you, be my guest. But from a cost benefit perspective, okay, cycle analysis is very cost effective. All right, now let's talk about unemployment. So inflation and unemployment. Here we are, the unemployment rate, currently 4.2 or so. This is also monthly data. And whoa, my goodness, we have a 67-month cycle in unemployment. Interesting. Other cycles on the spectrum include this 115, has very good strength at 70. Even this 203 down here. In fact, we can just put all these. Let's see what they all say. Whoa, okay. Unemployment looks very risky to the upside. There's a lot of cyclical pressure in the unemployment data that suggests that unemployment is likely to rise significantly in the coming months. But let's just stick with the 67 for now. And zoom in a little bit. We're up the cycle. We can see momentum has turned up. Obviously, we're still, swallowing this python here where we had a huge spike, came down dramatically. That was COVID, right? Where everybody stayed home. But we're clearly in the up cycle of unemployment and very good, clear cycles with good definition and good stability. So there you go. That is a beautiful cycle picture of fundamental data. Lastly, this is the employment ratio data. And again, I got this from Larry Williams. Full credit to Larry. He said he likes to look at the cycles in the unemployment ratio data, which is the number of employed people divided by the total population. So what percent of the population is employed? So we're going to see this is inverse to the raw unemployment data, right? So we got the big spike in unemployment here, and we see that over here in the employment ratio data as a big drop in the percent of the population that was employed during COVID. So only 51% of the population was employed. So again, not surprising, the cycles are very similar to the 67 and the 117. I think those are same cycles over. Sorry, no, that was the, getting lost here on my charts. Yeah, so we had 115 and 67 here in just the straight unemployment data. And so in the unemployment ratio, we've got 67 and 117. Both have great strength. Both have clear definition on the spectrum. And both have very good cycle stability. Turn on the momentum indicator. We got momentum rolling over. So again, the unemployment data shows very clear, unambiguous, cyclical pressures for more joblessness ahead. So if anybody has a direct line to Powell, let them know. CPI likely to keep coming down. PPI likely to go up a bit. CPI not coming down up for long. Going to be some pressures ahead, but we are going to likely see some increased joblessness over the next 12 to 24 months, maybe significant. So Powell is going to have some bad optics if CPI is coming down and joblessness is going up and President Trump keeps hammering on him as he has been for the past few months. It's going to be a tough road for Powell. He's going to have to thread a needle here in a very serious way. So incredible cycles in the fundamental data, CPI and unemployment, brought to you by the Foundation for the Study of Cycles. And let's now see what is on your mind. So pretty cool stuff, and very happy to be able to bring it to you. Guillaume, you predicted the World War III with cycles. It seems that it's happening. I'm not sure I predicted World War III with cycles, Guillaume. You're going to have to remind me of when I might have done that. By the way, while I was in New York City, I went and saw the Wheeler Big Book done in the 1920s with the students of Raymond Wheeler at university in the Midwest somewhere. Absolutely unbelievable piece of work. What a historical treasure. And it belongs to the Foundation for the Study of Cycles, but it is at the Technical Analysis Education Foundation at Baruch Library in New York City, hosted there by the CMT and the Technical Analysis Education Foundation. So really incredible there. We do need better data on cycles of war. It's an area that I would like to look into more. We certainly have been talking about conflict, but again, World War III, maybe financial World War III. I do think we're in the middle of financial World War III, but we'll get back to that. Such a pity I was not able to participate in the FSC conference. I hope next year I may have the chance to travel to the USA and participate. I hope so too. It really was an incredible gathering, and I really didn't know what to expect. You know, Science Day, the first day, I figured not many people would show up, maybe a quarter of the people, but everybody showed up, and Science Day was incredible. Wow, it was really inspiring, and we will be doing more in-person events. I'm absolutely sure of it. Peter, what about BTC? Okay, take a look at that. Started watching late. Just want to let you know in TradingView, you can export the Fred charts without needing to open the CSV up and edit. Yeah, I'm not sure on the monthly data. It's something I need to get Lars to implement, the monthly data type in the Cycles app. So Lars, if you're watching, really would be great to have the monthly data automatically available from Fred in the cycle analyzer. Do cycles say anything about how high unemployment will go? Good question. And, you know, we talk about cycles analysis a lot, that it doesn't really predict amplitude. So, no. In short, no. It just says it's likely to go up. And it's an area that warrants more research. But for now, I'm just going to give our standard answer, which is that cycles don't predict amplitude. Does the Fed look at cycles? They must. Absolutely, they do. I know they do. I mean, Arthur Burns was the head of the Federal Reserve, and there is plenty of correspondence in the archives of the foundation of Edward Dewey and Arthur Burns corresponding about cycles. And of course, Arthur Burns was part of the National Bureau of Economic Research, he was a student of Wesley Mitchell, who I think started the NBER and was a cycles guy for sure, collaborated with Dewey. So Wesley Mitchell and Arthur Burns, his protege, who became the chair of the Federal Reserve. The Federal Reserve knows plenty about cycles. They don't talk about cycles, you know, the way we do, but they gotta be looking at the stuff. It's interesting how the establishment uses things like cycles and technical analysis, but doesn't want to say they do. You know, I have this issue with Ray Dalio and Neil Howe and others. They're doing incredible cycles work, but they never actually use any kind of technical analysis or Fourier spectral analysis to say, look, here are the cycles showing up in the data. For some reason, that must have some kind of institutional job risk associated with it. So, so I'm sure they are using cycles, but they don't like to talk about it. So we will, and we'll take the heat. All right. So hopefully everybody sees the value in that. I get it. It's not short-term trading data, but I do think it really is essential for our, longer-term roadmaps. And I hope that you will keep an eye on it and incorporate it into your longer-term thinking and longer-term strategy. So we'll take a look at a few of the requests here, and then we'll wrap up for today. So let me pull up a few charts. All right, so I did happen to run a cycles analysis on the cash S&P in anticipation that you'd probably want to see something along these lines. So this is just daily data on cash S&P. And we see some clear cycles here. In fact, I can sort by stability now, 173 and 119. Also this 320. But maybe 79. So we're closer to a top than we are to a bottom. Also of note, we see big negative momentum divergence. So here was the high back here in momentum, right? Even back, if you go all the way back to 23, right? The high in momentum, it's about, about where it was here, right? And here. So you can look at this and say, well, momentum divergence doesn't work very well because that would have been bad trades, to not be long here. Well, that's the way the cookie crumbles sometimes. But now look at what's happening with the momentum divergence. It's getting lower and lower. Sherman McClellan was talking about this at the conference. The market breadth and the market liquidity is not keeping up with the moves in price. So that pressure is building. We don't know when it's going to unfold and exact its price, but it's certainly something to be cautious of. And the daily cycles are starting to reach a top. We also know, of course, that the weekly cycles in the cash S&P and in the stock market in general, especially the 41-month cycle, 180 plus week cycle, have topped as well. So here's the weekly data, 185 weeks. We've topped. Definitely got the correction. Now we're getting the rebound, but momentum isn't anywhere near back where it was at the top. So you have to be cautious here from a cycle perspective, no doubt about it. And Bitcoin, let's see, do I have Bitcoin? Let's just do, actually, I like the Bitcoin futures data. Oops. I like the futures data because it excludes the weekends where the trading is light. So if we look at Bitcoin on a daily basis, I'm going to sort by stability. The number one cycle is this 100-day cycle. Good stability above 0.5. But there's some others on here too, especially this 139 and 237. But all of these, if you combine them, suggest pressure from the cycles on Bitcoin, through July into August, maybe beyond. If you're grasping at straws, you want to pull in some of these other less bearish cycles, but the cycles are bearish on the daily data on Bitcoin. Just look at those top ranked cycles, top stable cycles. 5 out of 6 of them are all bearish. if we add them all up together, looks like pressure on Bitcoin into mid-August. And again, you got big negative momentum divergence, new highs here, but not a new high in momentum, going back to 24, March of 24. All right, and then last was the Japanese yen. So this is the US dollar yen ratio. So US dollar on top, yen on the bottom. Nice definition in the cycle spectrum here. 61, 89, 151, 203, 1, 2, 3, 4. We can sort them by stability. 203 looks the best. Maybe this 89. But when we add them all up, looks like US dollar likely to gain on the yen for at least a couple more weeks, but overall kind of updrafting into the fall throughout the summer, with the dollar likely gaining on the yen. All right. Well, that is 45 minutes of free content from the Foundation for the Study of Cycles. We really appreciate all of our followers and members. We had a rightful surge in membership in our master working group from the conference. A lot of energy around the foundation, the technology and the insights, and really the community that we're developing. So if you're not a member, I encourage you to join us. If you are a member, I encourage you to upgrade. We are on a roll. We're serious. We're working together. We're going to build this community, and we're going to continue to learn and study cycles and integrate them into how we navigate our world. So thank you, everybody, for joining us. Please subscribe, become a member, tell your friends and family, and let's do this together. Thanks, everybody. See you next week. Bye-bye.